of a $15,000 home gym purchase against that exact same amount invested in index funds. Over 15 years, the equipment steadily depreciates towards zero, while the invested capital compounding to $50,000 or more. Every dollar locked in these possessions is a dollar. The first belongs to someone earning $95,000 a year. Walk inside and you'll find a 75-inch television, a $4,000 leather sectional, and a kitchen full of appliances still in their boxes. This person checks their bank account with a knot in their stomach. They are exactly 2 missed paychecks away from crisis. The second apartment belongs to someone earning $52,000 a year. Walk inside and you notice space, a modest couch, a kitchen with exactly the tools that get used regularly. This resident checks their bank account with calm confidence. They have 18 months of expenses saved and invest 20% of every paycheck. The person earning nearly half the income has 10 times the financial security. Their advantage stems from a deliberate understanding of the relationship between physical stuff and money, a dynamic most high earners never see. Everything you own costs money twice. The purchase price, the number printed on the receipt, is merely an entry fee. There is an ongoing, invisible tax attached to every object you keep. Uncovering this second cost explains exactly how the middle class quietly drains its wealth to maintain a lifestyle it can barely afford. To see how this invisible tax operates, we can build a true cost ledger to audit the standard items sitting in most homes. This diagram shows the floor plan footprint of a standard treadmill. The first hidden expense is implicit rent. In most urban areas, residential space costs roughly $40 per square foot annually. When you map out the 20 square feet required for the machine and the necessary clearance, you are paying $800 a year just to store an object that probably functions as a clothes hanger most days. The second hidden expense is maintenance. Shifting our focus to a driveway, an item like a boat requires winterization, cleaning, registration, and insurance. The industry rule of thumb places annual upkeep at 10% of the purchase value. A $30,000 boat costs $3,000 every year to own, even if it never touches the water. The third expense is biological. Every physical item requires a small slice of your attention to clean, organize, insure, or worry about. Researchers have tracked how visual clutter increases cortisol levels, reducing your brain's ability to focus. The final expense is opportunity cost. This chart plots the trajectory of a $15,000 home gym purchase against that exact same amount invested in index funds. Over 15 years, the equipment steadily depreciates towards zero, while the invested capital compounding to $50,000 or more. Every dollar locked in these possessions is a dollar removed from your investment trajectory. This purchase is a direct trade. You are swapping decades of compounding growth for a collection of weights. Calculate the actual lifetime ledger, and the math shows that buying physical objects requires trading away years of future flexibility for temporary material comfort. Physical objects also deploy a trap called the lifestyle multiplier effect. Major purchases never exist in isolation. This network map shows how a single initial purchase acts as a central node. Buying a boat triggers a mandatory cascade of secondary spending. You need a trailer, a hitch-equipped vehicle, storage fees, safety equipment, and fuel. What looks like a singular expense immediately forces the creation of a costly, interconnected ecosystem. To defend against this multiplier, minimalists run specific formulas before swiping a card. This calculation reveals true value through cost per use. A $200 jacket worn twice costs $100 per wear. A $400 jacket worn 200 times costs $2 per wear. In any meaningful sense, the expensive jacket is significantly cheaper. The second defense mechanism is the replacement test. You walk through your home, look at an item, and ask, if this disappeared today, would I spend the money to buy it again? For impulse buys, old hobbies, and unworn clothes, the honest answer is almost always no. Applying these formulas strips away the emotional appeal of marketing. They mathematically neutralize the multiplier effect, cutting off the financial bleeding before a purchase ever happens. Society evaluates success by measuring visible accumulation, houses, cars, and premium brands. But that metric misreads how financial security actually functions. True wealth is optionality. It is measured entirely by your capacity to make choices. Can you leave a toxic job? Can you handle emergencies without debt? Can you relocate for a relationship? A high earner whose income is completely committed to maintaining a house full of depreciating assets has zero optionality. A modest earner who keeps their capital liquid retains the freedom to absorb disruptions and make decisions based on preference rather than financial necessity. The compulsion to constantly accumulate is often a symptom. Excessive purchasing acts as a temporary psychological fix, filling an emotional void created by financial insecurity itself. This diagram illustrates how to reverse that pattern. It forms a virtuous cycle. Lower spending creates higher savings. Higher savings build actual financial strength, and that strength naturally eliminates the psychological urge to consume. You don't need to buy things to feel successful, because your bank account already confirms it. Return to the image of those two apartments. The individual with 18 months of savings and complete financial calm arrived there through exceptional clarity, not exceptional income. Your financial trajectory is a choice available to you right now. True stability is determined entirely by whether you choose to own your possessions or allow your possessions to own you.